Hey, Saretsky here. Welcome back to the show. I want to walk you through some of the national housing stats that we got this week. I want to touch you on what's happening in the rental market, how it's impacting the development space, and how I think it's going to continue to impact the development space moving forward. Again, all sort of key themes that we've been talking about on this channel for quite some time. Um, National housing data came out this week, really indicating what we've been talking about on this channel for quite some time. Again, if you're watching this show, you're probably, a couple months ahead of the official reports that are coming out, which is effectively to say housing sales have bottomed and are increasing. Now, again, they're increasing from a very, very low base. So this is not like a housing rebound and bull market en route, but what is to say is that, okay, we're starting to see some housing activity clearly increasing, liquidity coming back into the market, which is helping a lot of the stale inventory slowly, and I want to emphasize slowly, starting to clear, albeit at lower prices, which again, we're going to get into in just a sec. So effectively what we're seeing here is, as I highlighted before, anytime like housing, especially residential housing, it's so emotionally driven. It's so psychological. For many people, it's their largest purchase, their largest investment. And so, you know, you want to make sure you're getting it right. And I think a lot of people ultimately follow their peers. I mean, there's a reason why anytime you see 30 pairs of shoes at an open house, everybody's all excited to make an offer and to go and compete and overpay above the listing price. You know, when you're the only person in the open house and your uncle and your family's telling you not to buy, you tend to take those cues and you don't buy. So people are very it's the animal spirits of housing is very, very real from what I have personally seen on the ground. And so anytime you get these policy shocks, think, foreign buyer tax in 2016, BC speculation tax in 2018, shutting down the global economy in 2020. And again, we had in 2025, you had the president of the United States basically saying, listen, we're going to crush Canada and they're going to become the 51st state. They were our neighbors, they were our partners, but now we're going to start tariffing them. And we're coming for all of, effectively, we're going to crush your economy and you might lose your job. Obviously, that is a huge policy shock that people needed to sort of stop. Market completely froze. They needed to sort of see how things are going to play out. And again, we don't necessarily have the answer, but I think people are ultimately becoming more comfortable. The tariff news, the shock of the news is starting to wear out. Now, the economic impact may have not yet played out, but the shock of the news is starting to basically wear its course. So effectively, what we're now seeing is liquidity returning to the market. As inventory has been growing and growing and growing, that's finally started to put pressure on prices. We're seeing, again, more sellers just reducing prices, and effectively that is allowing some of the inventory to clear, sales to increase, and we're starting to see, again, more downwards movement on prices as sellers adjust to the new reality that, listen, the housing market isn't coming back anytime soon. Yes, it ultimately peaked in 2022 and sort of been this slow grind lower. We know we've had some ups and downs over the last sort of 12 to 18 months. And again, in 2025, moving lower despite slightly lower mortgage rates and cuts from the Bank of Canada. So if you look from a national housing perspective, they're technically saying, oh, the benchmark home price was flat on a month over month basis. But if you now look from peak to trough, now again, it peaked in 2022. It actually peaked basically before the Bank of Canada started hiking rates. Ironically, is it peaked in February 2022, and it effectively bottomed It hasn't bottomed. I mean, we don't know if it's bottomed yet, but basically right now you've got national home prices down 18.5%. That is the largest drawdown that we've seen in 2 decades. We had some short drawdowns from 2017 into 2019. We saw about a 9% decline in national home prices. We saw that in 08, 09, another 8 or 9% decline in that era. So again, right now, you're effectively more than double the previous 2 declines. So again, this is the steepest, sharpest correction that we've seen in 2 decades once we started getting that home price index data. So it looks a lot more sort of like the late 80s and into the 90s. You had that blow off top, and effectively, you're in places like Toronto in the GTA, home prices took a decade to recover in nominal terms and basically 2 decades to recover in real terms. And this is again why I continue to emphasize to people that we have to be paying attention moving forward. Nobody knows what's going to happen. I don't know what you know, 12 months looks like from now, 18 months from now, 24 months. But what I can tell you is the current dynamics in the marketplace suggest that, listen, you've had a crazy run up in home prices over the last 2 decades. You have mortgage rates that are unlikely to move a whole lot lower from here, and you have an investor base that has been scared off from the asset class. And then we can see that effectively in the new construction market where pre-sale buyers have concentrated, speculators, investors have basically been concentrated in that market. And you have 30-year lows in places like the GTA, 10-year lows in Vancouver. The investor is not coming back to the marketplace anytime soon. And why are they not coming back to the marketplace anytime soon? Because there's unlikely to be a run up in home prices. But more importantly, as we've been talking about on the show, is declining rents. So even if you get a little bit of relief here on the mortgage rate front, which is probably not a whole lot of movement there, we're still seeing mortgage rates today about 4 to 4.2% for most clients. Again, you got to go out there and push your brokers, but you're typically somewhere between 4 to 4.2%. Unlikely to get a whole lot of movement downwards from here. But what we're seeing is declining rents, and that is because rental housing completions in this country is at all-time highs, going back or basically highs that we last saw in the 1970s before the construction model shifted from rental. The government actually changed a whole bunch of policies to basically kill the rental viability, and the market shifted to pre-sales, which is what we've been used to over the last 2 decades. And that model is clearly shifting again away from pre-sales back to rental, because the government, probably the only successful policy, in my opinion, that former Prime Minister Justin Trudeau brought in for the housing market, the only successful measure in that area was the CMHC rental financing program, which again allowed developers to basically go out there with high leverage to build rental projects. And clearly, if the intention was to add more rental supply to the market, that program by that nature was successful because, again, it has brought on record completions. But now what you're starting to see is, again, as you've curtailed immigration and all these rental buildings complete, you're now pushing rental prices down and vacancies up. And so if you look at, we can go back and look and see, all-time record high rents from where they were to where they are now in Q1 of 2025. And pretty much seeing across all markets, rents have come off from their peaks and are declining. And again, you could argue there's more pressure on the rental market moving forward because we still have a lot of rental units in the pipeline. We still have a lot of rental units that are currently under construction that we will be completing over the next 12 to 24 months. And it's unlikely the immigration number is going to move a whole lot again over the next couple of years, given all the policy changes. So again, I foresee more downwards pressure on rents that is going to keep the investors at bay. And that does not necessarily bode well on the demand side, particularly for condo units in the near term future. So again, we peaked in 2022. Don't know where the bottom is, but what we're starting to see is sales are starting to rebound as confidence returns somewhat as the market sort of unthaws. But ultimately, at the end of the day, demand remains historically weak, and I suspect that will probably continue to be the case as you look at the labor market playing out. We had some horrific data from StatsCan last week, but effectively, what we can see in the labor market data is that people that are losing their jobs or that are becoming unemployed, the amount of times that it's taking them to find new work. So basically, effectively, it's the number of workers that are unemployed for 27 weeks or more continues to rise. So effectively, what we're starting to see is actually people are dropping out of the labor force. If you stop looking for a job, you basically fall out of the labor force. And that's why the unemployment rate, despite the weak job numbers, has not moved higher. It's because the labor force has actually shrunk, keeping that unemployment rate at 6.9%. But what we effectively know is the labor market remains weak. The Canadian economy is kind of just muddling along. There's still some tariff uncertainty as to how this is all going to play out. So again, what I'm seeing, whether you're a buyer or you're a seller today, sellers, again, are finally starting to adjust to the reality. Prices are being discounted. Those price discounts as long are starting to entice more buyers into the market. This is ultimately bringing home price indexes lower. I think the best deals are being struck today when you have very little liquidity in the marketplace. I would argue that was more so the case, you know, 3, 4, 6, 8 weeks ago. But when you have very little liquidity in the market and you are the only buyer at the table, you have all of the leverage in the negotiation. Um, I'll give you an example of just kind of what I'm seeing, what I'm working with on the ground. We did a deal in downtown Vancouver. Again, this is a market that has been really, I mean, ultimately it actually peaked in 2018, has been weak. Really didn't see much of an uptick during the pandemic because people actually were leaving downtown condos and going out to the suburbs for more space. So it's a market that's really sort of languished since 2018. We just had a buyer purchased a unit a couple weeks ago, a 2-bedroom condo in downtown Vancouver that sold. We purchased it for 725,000. The exact same unit, one floor lower, sold for 825,000 just 12 months ago. So $100,000 less than the comp in the building from last year. And again, last year in 2024 was not a strong market. It was not a strong market, particularly for condos downtown Vancouver. So just to kind of goes to show you, and I would argue that condo probably at the peak, would have been probably closer to 900,000. So, we've seen a significant decline since 2018. That's again why I kind of caution people. Ultimately, they say, well, is it the time to buy? Now is the time to be pushing on negotiations. If you can bake in the price today, if you can go out and negotiate a good price today, everybody sort of waits for the home price index to bottom. And we don't know when that bottom is. You have to sort of negotiating a margin of error, right? I mean, if you can negotiate yourself a price that's 25% off the peak, I mean, I suspect you'll probably be pretty happy with that moving forward. It's similar to, again, I sort of give the analogy to the US where it's like, listen, that housing market peaked in '06. I'm bottomed in 2012, but if you bought in 2010, I suspect you probably weren't too mad about your purchase, even though technically the home price index bottomed for 2 additional years after that. But again, if you were able to go out and negotiate really good prices in '09 and 2010 in the United States. And I would argue again today, home prices peaked in 22, and there's been some good prices that were negotiated. Really, at the onset of 22, there's been some really good prices we've seen negotiated today in 2025. So it's kind of going in with that margin of safety where if you can kind of go in and actually get a deal. Now, I'd say if all the deals that are transacting today, still there's probably only 2 out of 10 deals that are actually like 2 out of 10 sales that are actually really good deals. Okay, 2 out of 10 are actually really good deals, whereas the other 8 are just sort of subpar. Yeah, they've come off a little bit. There wasn't a huge negotiation. So again, you still have to actually go out there and work to find your deals. Deals don't just land on your lap. You have to go out there, find them, negotiate them, and you have to negotiate them in these sort of liquid markets. And so again, cautionary tale, I think for the sellers, ultimately nobody knows where prices are going, but the sort of the old adage in the Vancouver housing market particularly has been, oh, listen, the corrections are always short-lived. I just have to wait till next spring. We've seen people saying that now since 2022, wait until 23, wait until 24, wait until 25. And we don't know if we'll reach bottom in 26 or 27. But what we do know is that all you have to do is to go back and look at markets that we had in the 80s. You can go look at markets I just illustrated in downtown Vancouver that peaked in 2018. That is now basically, call it 7 years of no price appreciation. You're still underwater 7 years later if you bought at the peak in 2018. So that's kind of what I'm looking at. You can see that in the national housing data. Again, peak to trough, sharp correction down 18% per the home price index. And it's quite likely that will continue to drift lower in the months ahead. So it is the sharpest correction that we've seen in 2 decades. You'd have to go back to, again, the late 80s into the early 90s to see a similar type of event. And this is why you're going to continue to see very few pre-sales in the marketplace that is going to create the future shortfall, but that is years down the road. And I would argue again, the model to finance new housing in this country is shifting away from new pre-construction condos to long-term purpose-built rentals. That is where the ball is going, at least over the next couple of years. So, as always, hope that helped. See you next week.